Hi, I'm Jane Mitchell, Financial Advisor here at AdviceWise, and I'm joined by Dr. Steve Garth, the Chair of our Investment Committee. So today we're just going to have a look at what the current state of markets are doing. This week with the Melbourne Cup, we also had the RBA increase interest rates again. So the question can be, are we there yet?
That is a great question. I don't know the answer, Jane. I have a feeling that we might have a little bit further to go here in Australia. It seems that in the US that they are probably there. I'm not sure the US are going to raise rates again. Their bond yields are quite high, which is increasing the cost of borrowing. So it's kind of doing the job for the Federal Reserve. Here in Australia, inflation does seem to be sticky. Unemployment is still at record lows. And all that contributes to inflation. So while it's on a path downwards, it's not coming down fast enough for the RBA. And they will have a natural pause in January. They never meet in January. So I wouldn't be surprised, but don't put money on this, that they will raise in December and then they'll let January play out and to see what's happening by February. But on the other hand, we could also be done. It's also data dependent. It really changes daily.
Yeah, because there's a bit of a difference between what the markets see the rates are doing, and because they're forward looking, as opposed to the Reserve Bank, it's always looking at data that's backwards looking.
That's so true, Jane. You know, when you read the papers after a rate rise, they seem to indicate there was some great shock, and the markets have reacted to it. That actually doesn't work that way at all. Have a look at the chart I've put up here. It just shows how over the last 2 years how the ASX 200 has behaved with all those rate rises we've seen, basically going from 0 up to the current 4.35. And you can see that there's not really a relation between interest rates going up and the market. In fact, the market had a pretty good run this year until July, and oddly that's when rates were on hold for the last 4 meetings, and it was at that period that the market started to come off, and that's probably got a lot to do with the central bank both here and in the US telling the market that, look, rates are going to stay higher for longer, they're not likely to come down as soon as you like them to. So the market's been coming off a little bit even though rates have been on hold.
Because the markets tend to factor in those kind of changes, what they see as the potential growth going forward.
That's absolutely right. And on that, Jane, there's a lot of talk about the economy slowing. That is absolutely right. The economy is slowing, which is what central banks want. But a slowing economy doesn't necessarily mean that the stock market's going to fall over. And for all we know, the recent fall in markets here in Australia, it's down about 7.5% from where it was in July. That's quite a lot. For all we know, that's the market pricing in the effect of the slowing economy, and from now it's going to go up again. We certainly know over the long run, Jane, that the market will go up.
But at the moment, we've got a lot of geopolitical issues happening. We had Russia and Ukraine last year. Now we have the Israel-Hamas conflict. So what's that impacting, or how is that impacting on our markets?
Yeah, that's a really good question. It's got a direct impact, which is quite small in a way, and that direct impact would be oil. And you did see oil spike up when that conflict first opened. Much the same in Russia-Ukraine when that first happened way back, 2 years ago. Oil spiked, and that certainly contributed to inflation. But then it seemed to balance out, and we've seen oil be coming down in the last couple of weeks. So the direct influence of these conflicts is relatively small, hard to measure. The indirect influence is even harder to measure, but it's got to do with the fear factor. Will this conflict evolve into something greater? And I think, as we know, stock markets don't like uncertainty. And so there's a little bit of fear out there that if this were to involve something greater, then it would have a serious impact on global growth and on the economy and on markets.
We have enough market data going back, significant amount of time to show that we've weathered a lot of these kind of issues. If it's not one thing, it's another we've gone through. 9/11, we've gone through GFC, we've had Brexit, we've had COVID, and the markets do fall and then they do recover, and it's about staying the course. It's about that long-term investing.
Yeah, because the other thing we know, Jane, is that suddenly rushing to cash doesn't really work. Timing the market has just been shown not to be an effective strategy at all.
Yeah.
You stick with the strategy that suits your risk profile and stay for the long term, and you do get rewarded for it.
Exactly. So that's our wrap up for today. So thank you, Dr. Steve, for all your input, and we will see you next time.
Terrific. Thank you, Jane.
Thanks.